Ladies and gentlemen, we have an intraday update here on AMC Stock as well as the markets, and boy, is there a lot you need to know. Hit that like button and subscribe to the channel if you are tuning in here, and if you are listening to my voice, then you should hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. So, first things first, let's dive into it with what Deutsche Bank is saying. A default wave is building, they say. Deutsche Bank strategist Jim Reed and Steve Caprio just wrote the bank's annual default study, now in its 25th year. Last year's correctly called for an end of the ultra-low default era. Though the current numbers are certainly not terrible, the U.S. high-yield bond default rate through April rose to 2.1% from 1.1%, and U.S. loan default rates rose to 3.1% from 1.4%. Over in Europe, speculative grade default rates rose to 2.7% from 1.7%. According to Fitch, the average U.S. high-yield default rate is 3.6%. So historically, you're still under the average for high-yielding default rates. But you have started to see this uptick happen. You're at 2.1%. We were at 1.1%. So you are already starting to see this. But Deutsche Bank team says a default wave is coming. Or default wave is imminent, they say. By the fourth quarter of 2024, they say the U.S. high-yield default rate will peak at 9%. And the U.S. loan default rate will reach 11.3%. Holy moly. The European speculative default rate will rise too, though to a less steep 5.8%. So basically what they're saying is Americans are over-leveraged and privileged to ultra low rates for the last 10 to 15 years, and now we just don't know how to deal with it, is essentially what they're saying. Because a 9% default rate and a U.S. loan default rate of 11.3% are insane. The default rate on mortgages back in the Great Financial Crisis was around 7%. So they're expecting some huge defaults to come. Now, it's not going to be in real estate this time around. We can make a whole reason why the Great Financial Crisis was unique, because people don't typically default on their houses too often, and granted, everyone basically has low interest rates on their houses. That's not really the main focus here. The main focus is corporate credit. It is the high-yielding markets. Now, when people start to default, or companies, I should say, start to default, it drives up rates for everything. Once there is more risk in these markets, it drives up literal rates on everything. And that is a huge problem for institutional investors. A lot of them that I have personally seen and talked to have talked about this high-yielding market that is great and wonderful, and this is the time to be in these high-yielding markets because it's been a long time since you have gotten 7, 8, 9, 10% on relatively risk-free, not risk-free companies, but lower-risk companies. But if Deutsche Bank is correct, there's going to be a lot of pain coming for hedge funds and institutions over the next couple of months. Now it says why. Like, why is this going to happen? Quote, the tightest Fed and European Central Bank policy in 15 years is running into elevated corporate leverage built upon stretched profit margins. This is especially true in the leveraged loan market, where LBO leverage was juiced higher year after year after year by zero rates and central bank QE, they say. LBO means leveraged buyouts performed by the $5 trillion or so private equity industry. And don't expect the Fed to run to the rescue either, as the central bank continues to fight inflation. Unmentioned by the analysts, but the debt ceiling deal effectively kills any potential for U.S. fiscal support through the next election, bearing an unusually nasty recession. So they're not too optimistic, needless to say. Granted, Deutsche Bank is far from the only outfit calling for a recession. Isn't a downturn and ensuing default built into prices? Maybe not. The Deutsche Bank strategists say investors might not be ready given that high-yield bond index quality has improved this cycle and global loan default rates have been tame for the last 15 years. They quantify this by looking at the percentage of speculative grade markets trading at distressed levels. Historically, distressed ratios lead default cycles by about 12 to 16 months. Regressing defaults by distressed ratios, they find the current U.S. high-yield market implying a 3.6% rate of defaults in the third quarter of next year, and European high-yield bonds pricing or projecting just over 2.2%. In our view, high yield continues to trade too rich relative to the economic backdrop, and we continue recommending selling into any strength and moving up in quality where possible, the strategists say. So they are forecasting nasty recession. Maybe they know something. Who knows? Wouldn't surprise me. Deutsche Bank in the past has been behind quite frivolous schemes and seemed to be privy to information that obviously we would not be. So we will see how that does unfold. On another note, the Hang Seng index, I have no idea if I'm saying that right, fell 1.94% last night. It is now in a bear market. This was supposedly the best area to invest in, according to analysts, over the last 3 to 6 months. People are saying the China recovery, it's coming, and you want to be invested in this area. And now everyone's invested in it, but it continues to fall. And really, nobody was expecting that because, after all, they're just now opening. Now, you might ask yourself, okay, what does China or emerging markets really have to do with what we're focused on here on this channel? A short squeeze with AMC. Well, it's all about the collateral. It's all about squeezing out dollars to essentially make hedge funds have less dollars. That's the main focus. Now, it's important to know, and it's worth noting, that emerging markets hold $244.1 billion, or 6.4% of the total hedge fund value or dollars is in these emerging markets. And China is the bellwether of emerging markets. They are the place that most of American hedge funds invest their money. Most of them aren't out in Brazil, buying their equities, or South America somewhere, or in the Middle East. That's really not happening. It's really China and India. And both of those markets are not really doing so hot, right? Obviously China, but India as well is also not doing so hot. So potentially a problem for the hedge funds, but it's only a problem when our markets start to actually come down. When our markets come down, that's when these guys are really going to have a problem, because obviously 6.5% of capital being in emerging markets, probably 4.5% of that, 5% maybe, in China alone. The rest of it's in America. Now, the American markets, if you track the index or large tech, they've been doing nothing but going higher. And again, today you're down about 0.39% on the NASDAQ, seeing a pretty decent recovery here intraday. We'll see what happens by the end of the day. But you're not at the point of getting a collateral crisis. You're not squeezing out collateral as of right now. But you are seeing signs that maybe this will start to happen. We've talked about these signs before. Now, what happened today with the economic data was also a doozy. So this came in at 10 o'clock in the morning today. I covered this in the last video, but if you have not seen the last video, we'll give you guys a rundown. Essentially, the JOLTS job openings is a measure of, if you want to think of like your local dollar store or Family Dollar or whatever, wanting to hire one worker. Well, that would be one job opening. So there is 10.1 million job openings in America. The forecast was 9.2. The previous reading was 9.75 million job openings. So just month over month, you increased about 400,000 job openings. And from the estimate, you're higher in job openings by about 900,000. So you're really seeing some not so encouraging numbers for the Fed. This is showing the Fed is going to have to raise rates again, and they're going to have to get even more aggressive. At the same time, Dallas Fed Services revenues came in at 6.9. You were expecting 6, so a little bit of a beat there. But Dallas Fed Services came in at negative 17.3. You were expecting negative 15. So pretty universal across the board today that bad news for the Fed. They're going to have to raise rates more, and that's basically the bottom line to it. If you take a look at what the markets are currently pricing in, there is a 64.1% chance of getting another rate hike in June, a 35.9% chance of getting a pause in June. So firmly expecting that rate hike right now. You're going to have to see Friday's jobs report come in really, really light, or you're going to have to see the CPI report June 13th, the day before the Fed meeting, also come in very light, and that's not looking too likely as of right now. On another note, AI is actually taking the first dip today. Stocks like Nvidia are actually in the red. I never thought I would see the day again. Nvidia was down. Nvidia is down almost 4% here today after obviously seeing a parabolic rally. So you are giving back some of this, and it's a positive thing for AMC for squeezing shorts out of their short positions. Nvidia is the third largest asset that is held by the NASDAQ. Nvidia is 6.5% of the market weighting in the NASDAQ. So if they go down, that's a good thing. And that's, what's happening. So there is that. Now, you're going to have more AI earnings coming out here very shortly as well. Here today, you're going to get CrowdStrike, Salesforce, C3 AI, Okta, Chewy, Nordstrom, Viva, Pure Storage, NetApp, and PVH. Now, Salesforce is one that I am actively trading in because they are like the AI software trade. If you wanted to point out one player here, Salesforce and C3 AI. These guys are like core AI. Now, the only thing that matters is if they give you good guidance. If they come out with some stupid, crazy guidance like Nvidia does, stocks are going up 25, 30%. That's programmed into the algorithms. If they do not, well, you're probably going to see Nvidia and other AI stocks take further moves down that would squeeze collateral out of these short positions. But I do have a trade currently on Salesforce. If you guys want to come trade with me live in real time, link down below in the description of this video. Come check that trade out before the end of the day today if you want to be a part of it. But nonetheless, let's go ahead and continue on. Let's give you guys an update on AMC stock and where the data is currently at for the day. So, got a short score of 89. $508 million worth of short positions in AMC, 21.25% estimated short interest of free float. Free float out on loan at about 34.5%. Shares out on loan 177.62 million. Days to cover 6.65. Cost to borrow 54.9 and 100% share utilization. You currently have 111.31 million shares that are currently sold short. I want to point this out again if you guys are unfamiliar. Short interest, the official reports actually dropped from a high that you've seen on March 31st of almost 27%. To May 15th, dropping to about 20.5%. This is very indicative of some positive news to come. Shorts don't typically cover unless there is a reason to cover, and it looks like short interest dropping, something positive is coming, and that is their reason for their covering. Now, again, you are currently in a reverse gamma squeeze. That's a fact. It's because of these deep in the money puts that continue to be bought on AMC stock. You have two more coming in here today. a June 16th $10 put for $282,500, a June 23rd $5 put for $66,000. It forces market makers to go out and buy the stock, or buy the stock if they're buying calls, or sell the stock, short the stock if these hedge funds are buying puts, and that's exactly what they are doing. So this just continues to compound on itself, and from my calculations, you have over 65 million shares that are likely sold short currently by market makers. That's a lot of shares. Relative to the volume that we see on any given day, if we take a look at AMC's volume, I mean, it's pretty bad. Like, over the last month or two now, it's just been pretty bad across the board. Today, you got less than 9 million shares that have traded hands so far. So these orders are having a very big impact on AMC's actual share price, guys. So that is going to do it here in this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comments section. You guys have a fantastic rest of your day, and I will see you in the next one.